Great. Thank you so very much. I appreciate the introduction, and I appreciate the opportunity to speak here before all these people. Um, as you said, I'll be talking about moving averages and successful trading with them, and even more successful trading with a moving average that I call my dynamic moving average. So we'll talk about that as we go along. Okay, so I've written 5 books so far. You mentioned TradeStation Made Easy. I also wrote Trading 101, Trading 102, Electronic Day Trading, and Getting Started in Trading. And I'm working on my 6th book, which is Grading the Gurus. And with that one, I'm testing a large number of gurus who have volunteered to expose their systems, test their systems publicly, and show all the results. So there's some brave folks that are allowing me to do that. I don't know if I'll have any friends by the end of the book, but I'm trying anyway. I thought it would be a good thing for the public to see. So as you said, I've been trading since 1981. Somebody said since I was 3 years for that. Hang on, I've got a screen in front of mine. I can't. There we go. Minimize. All right. So I was rated #1 trader by Start Research 2 years in a row when I was making my results publicly known. I made 365.25% one year, and the next year 178%, which put me way ahead of the crowd at that time. And I've been programming and testing since 1981. And since 1986, I've been teaching others to trade. Once I figured out how to do it, I thought, that was a hard entry, trying to get into the back door. And for me, at the time, I was the only woman doing it. And, it was hard to get through the good old boys network and to learn how to do it. So I decided to teach others how to do it. And there are my books. We'll go through that pretty quick. You know the titles already. And I'll keep writing. So if you want to see a list of my past appearances and future appearances, and a list of all my public articles, you can either click here on the presentation, or you can go to moneymentor.com and go to seminars, and then editorial to see the articles. I write frequently for Stocks and Commodities magazines, so you can see me there as well. Question is, can you actually trade profitably with moving averages? The first technical analysis thing that new traders seem to learn about is moving averages. That's the easiest thing to do, and most newbies come to that and say, oh, look, this looks great. I'll buy when it goes above the moving average and sell the moving average, and I'll make a fortune. And they all think that right in the beginning, and it's not quite true. You have to test your ideas thoroughly and come up with profitable results before you can trade that kind of thing. And there are some nuances that make that work, and there are some simplicities that make it not work. So you have to really work on testing your ideas. I spend about 10% of my time coming up with ideas and 90% of my time testing the ideas. Newbies don't always understand how a moving average is constructed, nor do they understand how they can make money with them. To help you learn about moving averages and how to test and compare them to end up with a profitable trading system. So let's talk first real quickly about what is a moving average. Like the name sounds, it is an average that moves. But what do you mean by moves? What's moving? So let's take a look at that. How does a moving average move? This refers to the way the average is calculated. Let's say we're going to use a moving average of length 5, and usually moving averages have 2 inputs, close, or open, high, low, close, comma, and then a number, which is a length, and we're going to start with 5 in this case. That means we take the last 5 prices, and we add them together and divide by 5. Let's see what that looks like on the next slide. So this is a moving average of price of length 5. We take price 1, price 2, price 3 ago, price 4 ago, and price 5, the last 5 closes in this case, and divide by 5. Yeah, usually we use closing prices for averages. One idea to use, just as an aside, one idea to use if you're trying to buy above the average and sell below the average will be to use the highs for the average above the average and the lows for the prices below the moving average. So you use two different values there. So we could write this formula something like this: sum of close of 1 ago plus close of 2 ago, etc., divided by 5. So what's moving? In math, simple moving average. In other words, an arithmetical moving average is calculated by summing up the prices of the instrument closure over a certain length of periods. So this is what Wikipedia would say about a moving average. Sum of the closes, comma, n divided by n, where in our case n was 5. And it's the number of calculation periods that we're going to use. So if you want to have a moving average of 10, you would sum up the last 10 prices. Again, what's moving? It's the calculation that's moving. We're going to move one bar to the right. With each subsequent price bar, we're going to move one bar to the right and then go back that 5 prices. One bar to the right, move back 5 prices. And so that is what's moving. As we move to the right on the bars, we change our moving average to the last 5 from that particular bar. So to make a moving average, we'll move through all the prices from the market data, taking 5 at a time and moving one price with each new closing price in the market. Okay, so that's, as we're moving to the right, we go 1 bar forward and 5 bars back. So when we're calculating this moving average, we don't just start immediately at the right-hand edge. We have to start at the beginning of the data all the way to the left. And I had 5 bars and then move forward 1, 5 bars, etc. So we're moving over one closing price at a time, adding 5 prices each time, dividing by 5. So here's what it looks like on a chart. This is a length 5 moving average, a simple moving average. And you can see that sometimes it's a good idea to buy above the moving average and sell below, but sometimes you have crossovers which happen, and we call these things whipsaw. What about this is a system? First, we need to know what a system is. A system is a collection of buy and or sell conditions. We could have a very simple construct to begin with, something like this: buy when the close goes above the moving average and sell when the close goes below the moving average. That's the first thing I mentioned to you. So let's see how that works. System 1, buy above moving average and sell below. And you'll see here, I put this into a program that I use for my trading and research. All my testing is done on TradeStation. And you can see that there are lots of trades generated, lots of trades. Almost every bar, and not every bar, but almost every bar has a trade where it's going, something's going above and something's going below this moving average. So that's a little much, but here's the code for the system. Condition 1, close is greater than average, and condition is less than the moving average. And then we say if condition 1, okay, if the close is greater than the average, then we buy the next bar at the market. Next, if condition 2, and that is close less than the average, then sell below. The name of it is S below, so we sell the next bar at the market. So we've got a buy condition and a sell condition. But there's a problem. There are no short trades. Why are there no short trades on the market? So let's go back and look at the chart real quick. You'll see that these are all buys. The arrows go up, 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 and then we have exits, but we have no shorts. We have no sells, okay? So we had no sell condition in the market, no short condition, I'm sorry, in the market. What this code does is buy, and then the sell exits, okay? So we've got a buy and an exit. We don't have a short condition. So let's talk for just 1 second, for those of us who don't know what a short means. I had a hard time in the beginning years ago of my trading career figuring out what short meant. I had to repeat that to myself day after day. Short means you're buying something you don't yet own. And originally, Short came from the fact that they had a log, and in the log they wrote all, by hand, wrote all the transactions between vendors, basically, and their customers. And so they wrote all these conditions, all these transactions down. But when somebody sold something before they actually owned it, they had a blank in the log. And that blank was called short. We're short an order. We're short an order. We don't have that in there. So it means you're selling something you don't yet own, while long buying something. Obviously, you don't own it till you buy it. But short means you're selling it and you don't yet own it, and you have to buy it back at a later time. Short means also that you're betting the market will be moving down. And I'm not going to tell you the story of the buttonwood tree here. Well, I have plenty of time left today, so I can tell you the buttonwood tree. In the beginning of the United States, the vendors, the customers and vendors, would meet at Wall Street, on Wall Street, at the buttonwood tree. There's a very large tree there. And they would meet under this tree to buy and sell their wares. And usually it was things like corn or wheat. And I don't know, they didn't have tractors, horses and plows and things like that they would sell. And when they would want something that they didn't yet own, they would put this messages on the buttonwood tree, and these were called bulletins. So when there were lots of bulletins on tacked to the or nailed to the buttonwood tree, then the market was bullish. Bulletin, bullish, get it? So when there were no bulletins, then the market was bearish because the tree was bare. So that's that little story, a little aside that's kind of fun. So if we consider a ledger of transactions, then let's go back one second. If we consider a ledger of transactions, then when there's a hole in the ledger or something not yet entered in this cell of the spreadsheet, so to speak, then you are short that transaction. Let's change this code now so that we have shorts in here. So again, we've got these two conditions. And if condition 1, then we're going to buy, next bar at the market. And in condition 2, then, it's not just a sell, but it's a sell short, which reverses this buy and goes short. So we're betting at this point that the market is going down. Now, this one looks a little different. Now we have some red arrows indicating sells, as well as the blue arrows indicating buys. Let's look at this performance just for a second. 0. Net profit is 0. So this is not generating the trades, apparently. No, we've got 656 trades, it says, but we've still got 0 for the performance. So something is wrong. Let's take a look once again at the code. So we've got these conditions. Buy above, next bar at the market, sell below. But notice that there's a buy and a sell on every single bar. Look at the chart. Buy, sell, buy, sell, buy, sell on every single bar. So we're going to move the code, modify the code, to move one bar back. So here's what the problem was. We were trying to buy and sell. We need to actually investigate whether the close was greater on the previous bar. And that's why we didn't generate any real trades. So we need to go one bar back and look at the previous bar. The square brackets with a 1 in it means 1 bar ago in TradeStation code. So now let's go again. We've got the same code going along, but this time we've got 1 bar ago. Okay? And if you look now at the close-up of this same chart, we've got buys and sells, and these dotted lines, red means you're losing, and cyan means you're winning. So if you'll see here, we've got a short, and it goes down to here, and now there's a win in there. So we're actually starting to either make or lose money based on these cyan bars going down, or lines going down, and we lose money on the red ones. So these progress lines show us whether or not a trade was a winner or a loser. This time, now we've got something on our performance report. This is a negative $1,000 basically. Total net profit minus 1,000 of trades now is 1,300 trades, and the average net profit per trade is negative 79 cents. So that's not what we want to try to end up with, obviously. We're going to try something else. Excuse me a second, I have a drink. I'll do that from time to time. So maybe the moving average of length 5 is either too short or too long. Maybe that's our problem. So this is how we go through research. We are constantly trying to test new ideas and come up with ideas that we can use to generate trades and try to generate profits. Generating profits through testing is really difficult. Doesn't think, oh, I'll test a system really quick and be a successful trader right away. And it's not that easy. It's, in fact, very difficult to come up with a winning system. I've had people come to me and say, I'm going to generate a winning system really quick. I'm a new trader. I'm going to generate a winning system really quick and start selling it. So people like to sell their systems more than they like to trade their systems. And I find that there are lots and lots of, quote, gurus out there who are not successful traders themselves, but are actually systems vendors, and the systems often don't work. So if you're going to buy a system from somebody else, you know, get it on trial and test it for a while yourself to make sure that it actually works. So this time, rather than incrementing or decrementing one number at a time, let's make the length an input, and then we can optimize to find the best results. So I'll show you what optimizing is like. This is the line that we're going to insert at the beginning of the code. Inputs, colon, length of 5. So that 5 now is an input value that we can optimize on. We're going to change the 5 in lines 1 and 2 to read length instead of 5. So here's our inputs. Now, instead of 5 here, we put the word length, and that's going to be an input value, and so we can vary that as we optimize, and the rest of it stays the same. So to optimize, you go to Format Strategy, you go to Length, and you click on this little Optimize button down here, and you start. I'm going to start at the value of 3 and stop at 27, so I can give it a pretty long run of moving averages, incrementing by 1 each time. So it'll go 3, 4, 5, up to 27. So we will have 25 tests to run. And I'm not going to run them here in front of you. I'm just going to give you the results. And you'll see here that this is a spreadsheet of all of the results from that test. The length of 27 gives us a minus $1,100, and etc. 26, 25, all those values. And you can see that all the tests were losers, but the least loss was for the input value of 3 down here at the bottom. So what we're looking here at is the net profit value. So what do we do now? We've learned that we can't make money with a simple moving average of any length just by going long and short as the price crosses. So let's try what I mentioned earlier. How about if we use the highs and lows instead of the closing prices? So system 4, we're going to be doing this, and this time we'll have inputs not only of length, but the price to use for the longs and the price to use for the shorts. So here we're going to use high for the longs and lows for the shorts. Semicolon ends the statement. And then we have condition 1. Now instead of close here, we have price for longs greater than average and price for shorts less than the moving average. And then this is the same because we have condition 1 looking at the prices. And as we optimize this system for highs and lows, it gives us the same dismal results. Reversing and using low for L for longs and H for crossing for shorts gives us minimally better results, but this time with a loss of $1,075 for the best test. And the best test this time is for a length of 5. However, the chart is promising. It's looking better. For instance, this one really good long short trade right here in the middle of the chart is actually captured. So that's one of the things we look at. We want to have, someone told me a long time ago that your system is correct or successful if you catch all the major trending moves. So if you catch this major move here and this major move here and that major move there, and you lose a little in the choppy periods, then you have, according to him, a successful. So the trades this time are farther apart. They're not just on one bar. Let's do a different concept now. We could go on adding limit orders to get better fills. We could enter at a fudge factor above or below the specified low or high. But let's try something else new. This one we're going to have two moving average crossing over each other as the trigger. And this is called a reversal system. It means you're always in the market either long or short. This is very commonly used. So let's test this real quick. We're going to buy when the short-term moving average crosses above the long-term moving average, and short when the long-term moving average crosses below the short-term moving average. So this time we're not looking for price to cross over, but rather for the moving averages to cross over each other. For this, we have to add another moving average. So now we have a chart with two moving averages. And you'll see here that they cross at the far would be a buy, and they cross at this next juncture, and that would be a short. And across here again, that would be long. So when the dark blue moving average is on top, we're going to be long. And when the cyan moving average is on top, we will be short. So let's take a look at that. I'm not going to show you the code for this one. It's real easy. It's in TradeStation. But you'll see that there are fewer arrows now, and that makes more sense. And we're going to use a fast length of 5 and a slow length of 10. And now we've got some promising results. And this is not optimized. It's just using 5 and 10. This time we have $300 profit. That's better than a minus 1,000. I've got some questions here. Is this a pitch for TradeStation? Absolutely not. I use TradeStation and have used it for 26 years. Love it. I also use multi-charts. I know it like the back of my hand, and I have no affiliation whatsoever with them. I just love the program, and I use it for everything I do. So thank you, Tom, for saying, does it matter? Question from D. Would they be the same length? I'm not sure I understand that question. What would be the same length? Give me another question, D. Okay, so now let's go forward, and I'm waiting for D's question. So total net profit is 300. This time we have a lot fewer trades. Instead of 1,000 trades, we have 131. Now we're getting somewhere. Okay, and we've got 35% profitable. That's in the range of percentages that professional traders use. People often ask me, shouldn't I have a system that's 80 or 90% correct? Wouldn't that be a successful trading system? And the answer to that is no. Those systems that are 80 and 90% correct often have trades that are $1 or $2 at a time. And those systems are never going to make you any money. Or they alternately have 1 or 2 trades, and that's the way they get 80 or 90% correct. If you have a system that actually trades frequently and is trading the reversals and finding those trends with each move, those systems are typically between 35 and 45% correct. And that's where the professional traders trade, 35 to 45% correct. Doesn't optimizing lead to data mining, which will not hold up in the future? Yes, it does, unless you do it my way. And I'm not teaching that in this particular webinar. I have another webinar where I teach you how to do optimizing without curve fitting. You're talking about curve fitting. And if you curve fit, yes, it won't work in the future. But I have a way of I call looking for islands and alligators. And some of you may have heard me talk about that before. But if you look for islands and alligators in your spreadsheet, you will minimize the curve fitting and maximize your returns, and they will work in the future. So look, I might have a webinar out at YouTube. If you go to youtube.com and search for Sunny Harris, you will find I've got 5 or 6 or 7 webinars up there, and one of them talks about how to properly optimize. So again, we click on the optimize button. We've got this time we're going to set it from 5 to, I think this is 35 in increments of 1, and we're going to see what these crossovers yield. 775 tests this time, and here, after optimizing, we have $1,400 profit, which is definitely better. I think you'll agree on that. That's better than $300. But again, it's not quite right. It doesn't catch all of the trends that are here. You'll see we've got a long trade right here in the middle of a good move down. So something's wrong there. You'll see that we've got long here and short there. So something's wrong with this system. So $1,450 though in just 5 trading days is pretty good. Still something's wrong, but we've got good results. So it looks good, right? What is the problem? First, the average trade size is a measly $4, which is not possible to catch. I trade the E-mini, and the minimum move is $12.50. So $4 for an average trade is not going to get you very far. You need an average trade size that's above $25 in this case for you to actually have a decent system. And second, in this one, there were 55 trades in just 5 days, and I can't do that many trades. Automated, perhaps you could do it, but I personally don't like automated systems, and that's just too busy for anybody. Thirdly, the best settings were 6 and 5, with the fast-moving average being slower than the slow-moving average. And that, the 6 and 5, is the reason that we were getting shorts where we should have had longs, and longs where we should have had shorts. So something has to be added to get the 6 and 5 to be 5 and 6 instead of the reversed where it just doesn't work with 6 and 5. So remember that the minimum move on the E-mini is $12.50. We've got to take that into account. The code is getting kind of long, but here's a snippet of the code. We're going to set the input values to the integers 1 and 4, and we can optimize to find out whether the close is the best input. This time we're going to have if price longs equal 1, then value 1 equals open. Okay, so we're going to the input values will be 1, 2, 3, or 4. If it's a 1, then we will use the open as our input. If the input value is a 2, then we're going to use the high for the calculation. If price longs is 3, the input value is 3, then we're going to use the values low. And if price is 4, we're going to use the close. So this is a great way, great little snippet of code here for you to use to test open, high, low, and close all. So you can't optimize. For instance, if you put the word open in there, you can't optimize on that. You have to optimize on a number. Sorry, taking a drink again. So turns out when we do this optimization, that close was the best test. So we'll try another trick. Our problem number 3 was that the fast moving average was slower than the slow. We had 6 and 5. Let's take a look at that now. So disallow reverse settings. So if the fast length is less than the slow length, then begin. That's all we have to do is put the fast length less than slow length, then begin. So that disallows any values which are reversed. So we don't get any 6s and 5s anymore. We get 5s and 6s all the time. Let's again and see what happens. Now we have $1,000 in, I think it was 5 days. And you'll see that this is short where it should be, and this is long where it should be. Here's another short, and this is long again. We're doing the right thing. But again, we've got a problem right here. There's a short trade where it should only be long. So we're constantly testing. This time, take a look down here at the percent profit. Instead of 35, we're heading in the right direction. So it's better still, but it's not ideal. Question that I use all the time, my favorite question, is what is true? So when we look at the chart, we have to ask what is true. What was happening on that chart? What was true? Okay? And that's how we brainstorm ideas, by asking what is true. First, the average trade size is too small. It's only $4.79. Secondly, there were too many trades. and the average is simple. Maybe we need something besides simple. So let's try some different moving averages, different types. There's weighted, there's exponential, there's adaptive, and then my dynamic moving average, which I call my DMA, dynamic moving average. And I'm going to show you that in a few minutes. Let's take a look at what the different moving averages look like. Here's simple versus exponential. You'll notice there's increased jerkiness. See the jerk here and the jerk there and the jerk there. This is better in many ways, but it's too jerky. Let's look at weighted for a second. Okay, the green one is weighted and it's still jerky, but I think that the weighted is actually better than the exponential. It's smoother. So let's calculate. Let's show real quick how to calculate a weighting moving average. It's kind of a complex mathematical formula. Let's look at an example first. A shipment of 10 cases of widgets costs 20 cents a case. Because heavy consumption of widgets, a second shipment is ordered, and we have 40 cases now costing 30 cents per case. So we have to calculate a weighted moving average to weight these 10 cases at 20 cents and 40 cases at 30 cents. So the average cost is determined by the formula 20 cents plus 30 cents divided by 2 is 25 cents, is not an accurate measure of the average cost because it does not take into account that there are 30 more cases being purchased at 30 cents than at 20 cents. The weighted moving average would return 25 cents or 28 cents, which would be a more accurate representation of the average cost of widgets. Okay, so you've got to weight the average based on how many as it is of the prices. So here we have the sum product of A2 to A3 and B2 to B3 divided by the sum of B2 to B3. So it's a sum product. It's taking them and multiplying them instead of just adding. So it's multiplying and adding both. So it's kind of complex. We just let our program take care of all that, whatever you're using. TradeStation, Multicharts, Ninja, Genesis, I don't care. They all have it in them. So an exponential moving average is calculated by adding the moving average of a certain share of current closing prices to the previous value with exponentially smooth averages. So that's the latest prices are given more value. And we have P, which is a percent that we weight these with. And this is the formula. I'm not going to explain all this, but this is the formula to calculate an exponential moving average. We're weighting it by a percentage. And that's self-explanatory. So if we look at my dynamic moving average, and I can't give you the formula for this one. This is proprietary that I developed about 20 years ago. And the reason I did this is because I was really worried about whipsaw, and I wanted some kind of average that would accommodate whipsaw and not move back and forth across the whipsaw, but stay in one position. And you see here that this is a much smoother average. It doesn't have those jerks nearly as bad as either weighted or exponential. So let's look at the crossovers of the two moving averages. I always use purple and gold. So when these are reversed, usually when purple's on top, it means long, and gold on top means short. But in this, for long, and gold on top for shorts. Purple on top again for longs. So I've just got the colors reversed. I don't have the formulas reversed, but the colors in this case were entered wrong. So you'll see here that there's no whipsaw in this moving average in this whipsaw period. So it stays on top for long periods and then reverses and stays in that position for a long period. Again, reverses and stays with that trade for long periods of time. And if you look at them closer, you can see we've got an exponential moving average, a simple moving average, and then my Sunny dynamic moving average, the DMA. And you can see the difference right here. For instance, purple stays on top this entire time, while the cyan and magenta lines cross over each other several times. And in the whole time that that's crossing over, there's other crossovers back here. Mine stays smooth the entire time. And that's, I've had other mathematicians tell me it's brilliant, that they've tried and can't come up with it. And you'll find in all the programs that you can buy that generally they have something called an adaptive moving average, which is an attempt to do what I'm doing here, but it's not successful. Here we have simple moving average of 8 and 13, and then my dynamic moving averages of 8 and 13. So 13 was gold, and in this case 8 was purple. Notice that it doesn't whipsaw. So if you'll count the crossovers of mine compared to the crossovers of the simple, you'll see the difference. So if you look at the performance, this is the simple moving average crossing over at 8 and 13. And we have a minus $6,000 over 5 years. And the DMA at 8 and 13, you'll see there's one long and one short at the far end. And with this one, we have a minus $2,000, which is still not successful, but far better than the other one. So we have to optimize in order to find the right settings. And if we optimize over 1 year of data, you find very quickly that $25,000 is the typical kind of result that we get on my dynamic moving average. There's something else that I've added, and this is far more recent. This is only about 15 years old. And this is, I call SunnyBands, and this is 2 channels from the 2 dynamic moving average lines. I have one at 1.2 average true ranges and the other one at 2.0 moving average true ranges. And this way we ask the market where it's going. We don't tell the market where to go, but we ask it where it's going. When you use standard deviations, like in Bollinger Bands, that's telling the market where to go. You to those standard deviations. I'm actually asking the market where it's going by using its own calculations. Average true ranges are told to me by the market itself. So here we have SunnyBands. Now I've got the colors right. The gold is on top as it should be. So the SunnyBands are calculated at 1.2 average true ranges above the gold line and 2.0 above the gold line, while the bottom one is calculated from the purple line. So you see the bottom band is calculated off the lower moving average, in this case the purple one. This is unusual. Nobody does this kind of thing. And out at the right, I write the values for each of these. The crossover was on top, purple on top at 1740, and it gives the price. And here's the outer top band, the inner top band, the midline, which is the average between these two. It tells you very clearly purple's on top at this point. The difference between the inner bands and the outer bands is given here. The bottom band value, the outer bottom band's value, and the angle. The angle is gray at this point because it means it's not moving very much. It's kind of flattish. And when it's gray, it means it's between +1 and -1. If it's green, it's greater than 1. And if it's red, it's less than 1. So it's a lot of information is given to you very quickly there so that you can see at a glance. You don't have to think. You don't have to look. You don't have to analyze. It's all right there. So if you trade SunnyBands, what I'm going to talk about here. The rules are very simple. There's the simple rules, and then there's the rules that are one step away from simple, and so those are the advanced rules. The simple rules are you go short when you've had green candles coming down, and they penetrate the outer band and turn, when you've had, go short when the green candles are going up, green candles are going up, bands, and turn red. So we go on this green candle that was up, turn red, and now we go down. So it has to penetrate the band and then reverse directions, or reverse color. We take profits when the red candle touches the inner or outer band and turns green, in this case down here. We go long when the red candles have been going down and touch the sunny band and turn green. Then we go long. Those are the simple rules. take profits when the green candle touches the sunny band and turns red. The conditionals are, if the DMA, that's the dynamic moving average, which is the purple and gold lines, if the DMA is long, which means gold on top back here, then we, quote, expect trades to favor the long side, and thus we exit when the candles touch the midline, and vice versa for short. If we're trading against the gold line, that's when it touches the DMA. If we're trading against the purple line, for instance here, this is a good example. We've got purple on top, means we're favoring shorts. We go long at the bottom against the purple. We touch the purple and take our profits and go short. Come down here, we go long, touch the purple, and go short. And that happens over and over and over. So I have these rules available on my website. This is a real quick showing you Bollinger Bands and how they don't tell you where to take the trade. In fact, they're way away from the market here, you see. And they're very far away from the market. My goodness, I hope you didn't hear that. That was terrible. It means the market's closing. So Bollinger Bands are way away from price, and SunnyBands are right on price, showing you exactly where to take the trades. And you can see here, this is an overlay. It's kind of messy, but it's an overlay of Bollinger Bands and SunnyBands. A lot of people ask me, aren't your Bollinger Bands? And the answer is no, they're not at all alike. The way they're alike is they're both bands, and that's the end of that. So I'm 45 minutes early. I'm happy to answer questions for the next however long you want to ask questions. There are more kinds of moving averages, there are more ways to optimize, and there are more ideas for manipulating the rules. After many, many years of trading, I developed the dynamic moving average to avoid the pitfalls of whipsaw. Everything else I've tried doesn't outperform it. Everything else pales in comparison. So let me show you. I'm going to give 20 to 40% off for the rest of the month. If you've attended this webinar and either call me or email me and tell me you want that discount, the more you spend, the bigger the discount. So if you spend, I think it's up to $1,000, you get 20% off. Up to $2,000, you get 30% off, etc. So the more you spend, the bigger the discount. And that will be available on my website at all. Anything includes consulting time and my autograph book and indicators and strategies. Anything that I offer on my order form is available for this 20 to 40% discount. This thing only happens once a year, so don't let it pass you by. When it's the end of the year, it's gone. If you call me on January 1st and want the discount, I will be sorry, but it will be gone. So also, if you call me, now this is not email me, but if you call me and we talk, then I will give you my bean tick indicator for free. And there's my phone number, 760-908-3070. That's my cell. I have it on me at all times, so give me a call and we'll talk and you can have the free indicator. So there's my number, and I do love to talk to other traders. I love to spend time with people and get to know them. Don't be afraid to call me. I've had people call me and say, oh my gosh, you answered your phone. Well, of course I answered my phone. It rang. So, don't be afraid to call me. I'm serious. So let's answer some questions for a while. Bill Ritchie says, does your DMA work on any market? Yes, it works on any market in any time frame. So it doesn't matter if you're trading gold or oil or gas or the S&P or stocks. I trade stocks long-term on a daily basis. I have a stock portfolio that's long-term, and I trade it with my SunnyBands. And I trade 1-minute charts on the E-mini, and it works just the same. It doesn't matter. The rules are exactly the same. Rhonda says, are SunnyBands equal to Keltner channels? No, they're not at all equal. You can put them up and see the differences. The difference with Keltner channels is based on an exponential moving average, which we saw was too choppy. And it is similar in that they're both channels and they're both based off of a moving average in the middle. Mine is based off my dynamic moving average, which is real different from any other calculation. Not even close to the same as an exponential moving average, because I've smoothed out all the choppiness, I've smoothed out the whipsaw, and moving averages, frankly, are the most choppy of any and the most whipsaws. So Kellner channels will give you a lot of whipsaw and a lot of losses, whereas my DMA, which is the SunnyBands is based off of, smooths out all of that. Roxy says, can I put up my last slide? This is my last slide. Do you want the previous slide? I don't know which slide you want. Let's go back a little bit. You want this one? The offer? Sunny, you did not mention time frames. I think I just mentioned that. It works in any time frame. So 1 minute, 5 minute, 2 minute tick charts. And it also works on all the other kinds of charts. It works on range charts. So anything that you put up there, it works on. Math is the math, and a chart is a chart is a chart. So it doesn't matter. So to use my system, yes, I need TradeStation or multi-charts. It does not work on Thinkorswim. Sorry. I don't know Thinkorswim's language. I don't know how to program it in their language. So I don't have that available yet. I contacted them to see if I could get someone to help me convert it to Thinkorswim. And they said, yes, they had programmers that they charged $400 an hour to program it. So I haven't followed that up yet. No, it does not work with NinjaTrader either. It works with multi-charts and TradeStation. And that's all it works with at this point in time. Oh, you want the one with the SunnyBands and the Bollinger Bands. Okay, let's go back to that. Back. There you go. SunnyBands and Bollinger Bands together. Does it work with bar charts? Absolutely, yes. And no, there's no relationship at all to the commodity channel index. Forex, yes, it works beautifully on Forex. Is it available for CR charts? No, it's only available for TradeStation and multi-charts. TradeStation and multi-charts, that's all I have it for at this point in time. I would like to spend some time getting it available on the others, and I have not done that. It's very expensive, and I haven't gotten around to it yet. So if anybody wants to send me around to it, I'd be happy to look further into that. How about some more questions? I'm out of questions on this scroller. Great information. Started when I was 3 years old. Better sound. So that's all the questions that I've got on my list. So if there are, can you explain some entries on the slide from Roxy? Yes, I'd be happy to explain some entries. This slide with Bollinger Bands, we have to ignore the Bollinger Bands in order to do this. But let's look here. We've got price coming down on a red bar. It turns green. On this green bar, come up here, we're against, now purple is on top at this point, which means we're favoring shorts. So with purple on top, I'm only going to go up to the DMA. As soon as that ticks right there and touches that, I'm out. There's something called a matrix in TradeStation, and it allows you to enter trades, limit trades, and stop orders. So you put your trades in that, and the minute it ticks up here and touches that DMA, and remember the DMA value is out at the right. So on you're trading at the right-hand side of the chart. So if everything at the right gives you the values, you look at that value for the DMA, you enter that in the matrix. When it touches, you're out and you go short. So now we go back down, we go short. Here's a red bar. It penetrates the outer band. We turn green right here, we go long. So now we're long. Purple's on top. We only expect it to go to the DMA. This value is set in the matrix. It immediately exits that, and we go short. Now, it goes down. It touches the band on a red bar. It turns green, and we go long. The minute it ticks that on that bar right there, we go long. Now, you'll see gold is now on top. So we're expecting it to go long because gold is on top. We go long. Up here, there's a green bar that touches the band. We go short on the red bar, and we only expect it to come to the DMA. Now, example that you have to do some thinking. It comes down this direction. Gold is on top. We only expect it to come to the DMA. We've got two red bars. They come down. This bar is a doji. It is not green or red. Next bar is green, and then we're not touching this DMA at all, but we've reversed. And because of that, you're going to either exit or you're going to go long. I would go long because That's got a red bar, a doji, and a green, and it hasn't come down to the DMA. If you use common sense, it's clear that you have to get out of this and go long. And there we go, long, 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 up to the top, and it penetrates on green here. We've got a doji, doji turns red, we go short. Now, here's another rule. We're short at this juncture. It doesn't go to the DMA, but it turns green, and it goes above the high of this bar. We get out. You can choose to go long or not. I go long because it penetrated the high of that bar, and we're long again, and we just keep going over and over and over again. We just follow those long and short, and we're trading with the SunnyBands and the DMA, SunnyBands, DMA, SunnyBands, DMA, over and over and over again. Let's see if we've got any. We have no idea where I'm pointing. Oh, great. Let's see. We'll get a line there. All right, here we go. Here's one example. Here's the one where we went long, 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 came up here, we're out at that, we come down here, we touch the SunnyBand, we go long, back up here, long, 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 we penetrate and go short, we go short, short, short. Now here's the place where it doesn't quite come down. Does that help? We've got some pointers there now showing the long and shorts. All right, very good. Any more questions? You want to talk about a different subject? I'm happy to talk about anything you want to talk about trading. Or if you want to know my life story, I'll tell you that too. Whatever you'd like to know. All right, no one's listening. Everybody went to sleep. All right, folks, don't forget the special 20% to 40%, depending on how much you spend. 1,000, 2,000, 3,000 are the limits. Profitable trader. I live off my trading income. That's all the money I make is from trading. I live very nicely, very comfortably. I've been trading, as I said, for 33 years. There are times that I have losses. Obviously, everybody has losses. Everybody has losses. It's just get used to it. Losses happen. But you want to have greater winners than losers. And you know, like I showed you on the chart, even there's a losing trade right there on that chart. So yes, I make my living trading. I've been making my living trading for 33 years. Before that, I was a systems programmer at Lockheed, made my living that way. Then I created my own company, and we created the first computer graphics software ever in the 1970s. I retired from that company. I retired a multimillionaire. I gave all my money at that point to money managers to manage for me. It took them 3 weeks to lose $75,000 and another 3 weeks to lose another $50,000. And I said, that's it. Give me all my money back. I can do that well on my own. I don't need you to help me lose money. So that's when I started learning to trade. And I've been trading ever since for my living. All right. Thank you, folks, very much. Yana says thank you. So I guess I'm done. We're 33 minutes ahead of time. Don't forget the specials. They will be over on the 31st with no exceptions. Thank you very much.